Hey guys, Jordan Dove here. I hope everyone's doing well. Hope you're happy, healthy, safe. I'm grateful for you being here. Thanks for checking in. Appreciate it as always. Today I'm going to talk about creative financing and a form of it. And the form I'm going to talk about today is what we call in the industry a subject to. So, as you know, there are plenty of ways to purchase and take ownership of a home in the United States. And there are traditional ways to finance and purchase, and there are also unconventional ways, which is what we call in the industry as creative financing. So, for many of you who are workforce employees and your W 2 employees, most will opt for conventional financing through a mortgage broker or a loan officer. And I've discussed this in the past conventional financing, government issued loan, such as FHA, VA, or USDA. However, for this topic, I'm going to discuss the subject to, sometimes referred to as subject number two financing, and we're going to get into it. So I'm sure you're asking, well, what is creative financing? And according to Bankrate, creative financing is an innovative or unusual way of structured loans that allow a person to buy a home, land, or some other major item. So in creative financing, the seller of the property agrees to carry the note of the mortgage of the property. So let's talk a little bit about the history. I want to talk about the due on sale clause. Previously, people used to do loan assumptions and they would transfer that loan. So originally, loan assumptions, it was a state issue, and many states allowed loan assumptions and they disallowed the due on sale enforcement unless the banks could prove that the purchaser could not qualify to make these payments. However, in 1982, the Garn-St. Germain Depository Institutions Act made due on sale clauses a federal issue, and it struck fear in home buyers and home sellers, and it gained a lot of traction. So very quickly, the banks ran themselves into the ground. Buyers could not qualify for the entire loan, which means sellers could no longer sell their homes. And when those homes didn't sell, what do you think happened? Well, the banks started to begin getting these properties back at an alarming rate. They were coming back quick. And I gotta ask you, 1982, does that sound familiar? Does it sound something like 2008? This wasn't the first market to see the banks create a housing crisis. However, today, assumable mortgages, they're extremely rare, if not impossible to find in the year 2022. Cannot find assumable mortgages because they have due on sale clauses once a property is sold. Enter subject to. So you got to be asking, what is a subject to? Well, subject to means that the buyer takes over the seller's remaining mortgage balance without making it official with the lender. It means the home purchase is subject to the existing mortgage. This means that the seller is not paying off the existing mortgage and the buyer is now going to begin taking over payments. The unpaid balance of the existing mortgage is then calculated as part of the buyer's purchase price. So, for an example, let's assume the seller took out a mortgage of $400,000 and the seller has already paid off $100,000 before they decide to sell the home. The new buyer is now going to make payments on the remaining $300,000. Okay, so $400,000 was the original mortgage. The balance is $300,000. That new buyer is going to make payments on the remaining $300,000. So under a subject to agreement, the buyer continues making the payments to the seller's mortgage company. The difference between an assumable mortgage and subject to is that there is no official agreement in place with the lender. Moreover, the buyer has no legal obligation to make the payments. If the buyer ends up happening to not pay the loan back, if they fail to repay the loan, the home could then be foreclosed on. For the seller, this means if the buyer stopped repaying the loan, it would also remain in the mortgagee's name. The mortgagee is the seller. So I want to talk about the legality of this. Is subject to legal? So we know that lenders no longer work with buyers and sellers by allowing loan assumptions, but acquiring properties subject to existing financing, that is still continuing. So yes, subject to answer the question, it is legal. It shows up on the HUD 1 on lines 203 and 503. And this is an excellent way to acquire properties anytime the seller agrees to sell by transferring title to the property while leaving financing in their name. So many homeowners, they're unaware of this type of sale and purchase, and you will receive pushback from homeowners. That's pretty common. You're going to have to educate them. Education is the key, and you'll be helping homeowners get out of bad situations. That's not a terrible thing. Just make sure that you're not convincing a seller to sell you the property this way. I knew somebody, an investor, who purchased a property subject to, got a good deal on it, got the guy out of a bad situation, ended up selling the property 3 or 4 years later for a good return, a nice profit, and the original seller of the property wanted to sue them. There was an attorney who was hungry, wanting to make name for himself, young attorney, and putting food on the table for his family. And over the course of 12 months, the buyer of the property ended up paying between $40,000 and $50,000 in legal fees for doing something completely legal. The case was eventually dismissed. He won the lawsuit, but he lost a year of his time, not to mention the emotions and the anxiety that goes on with something like that. And so you have to be careful and try not to force somebody, have them make that decision themselves. As a licensed agent, when I'm representing a client as Jordan Dove, Dove and Associates and Nationwide Realty, we are representing them on the open market to get them as much money as possible, whether they're facing a foreclosure, whether it's a traditional sale, whether they've already received a notice of default or notice of sale. Our job is to get them the most money possible. As an investor, as a separate entity who is not a licensed agent and you're a real estate investor, you can use this as a tool in your toolbox. Okay, and it turns out that transferring title to a property secured by a due on sale mortgage is not illegal. It turns out that there is actually no federal or state law which makes it a crime to violate a due on sale clause. The due on sale clause gives the lender the right to demand payment of the remaining balance of the loan when the property is sold. This is a contractual right and not a law. The lender has the option to call the loan, but is not required to do so. And in my experience, and the experience of many investors across the country, lenders actually prefer to keep a performing asset on their books rather than risk the time and money and the expense of a foreclosure and holding a non-performing asset. Another story I could share with you about this is I know another investor who bank came in and said, hey, they saw that the title was transferred. They said, hey, this property was sold. It's due for sale. You need to make this payment and pay it off. And they went all the way up the bank chain because there was nothing in there that says that they could not do that subject to. And they ended up just allowing them to make the payments, and it was all good. So besides, in reality, why would the HUD-1 closing document contain appropriate spaces if it were a crime to take property subject to an existing loan? So this is a very creative way to acquire property. You may have somebody that is facing a foreclosure, they can't make their payments. You can come in as an investor and you can offer them, maybe they owe $150,000 on the property at a 3% rate, the home's worth $300,000. Maybe you give them $50,000 in cash to walk away, not face the foreclosure, because in a foreclosure you could walk away with nothing. Why not take some money, walk away, you assume the payments, and then you have some equity on the equity on the property, and it's a win-win for everybody. All right, so there are 3 different types of subject to options. Okay, not all subject to loans look the same. Typically, there are 3 types of subject to options. The first one is a straight subject to cash to loan. This is the most common type of subject to. And what happens is it occurs when a buyer pays in cash the difference between the purchase price and the seller's existing loan balance. So, for example, if the seller's existing loan balance is $150 and the sales price is $200, the buyer is giving the seller $50,000, which I kind of just discussed. A number 2 way of doing it is a straight subject to with seller carryback. Seller carrybacks, which is also known as seller financing or owner financing, is where the seller becomes the bank. These are most commonly found in the form of a second mortgage. A seller carryback could also be a land contract or a lease option sale instrument. So an example of that would be, suppose the home sales price is $200,000 with an existing loan balance of $150,000. The buyer is making a down payment of $20,000. The seller would then carry the remaining balance of $30,000 at a separate interest rate and terms negotiated between the two parties. The buyer would agree to make one payment and to the seller's lender, and a separate payment, one to the seller with a different interest rate. The third way of doing one is called a wraparound subject to. A wraparound subject to gives the seller an override of interest because the seller makes money on the existing mortgage balance. A wraparound is another loan that contains the first, and it can be seller financed. So using the same example that I just did, suppose the existing mortgage carries an interest rate of 2%. If the sales price is $200,000 and the buyer puts down $20,000, the seller carryback would be $180,000. And the seller can therefore charge the buyer 3%. The seller will make 1% on the existing mortgage of $150,000 and 3% on the balance of $30,000. So the buyer would be paying 3% on $180,000. Okay. Now keep in mind there are some risks involved. There are some pros and cons of buying subject to real estate. Sometimes it's good for a flip. Maybe you want to turn it into a rental. This is a way for people who are distressed, but there are some pros and some cons. First, I'm going to discuss the pros, which, it's fewer upfront costs. It's a quick sale, much easier to qualify than traditional financing. And it may mean more profit for you, the real estate investor, and it may mean a more favorable interest rate in a raising rate environment like we are in now, because with the recession that we're already in, people may have bought 1 or 2 or 3 years ago. They lose their job because we're starting to see the layoffs, and now they can't make their payments. They start falling behind. You could do subject to and get that loan, start paying their loan. Maybe they had a 2.5% loan, 3% loan versus 6% that we're seeing now. So that, I think this is going to play a major factor in the coming real estate market shift. I think people are going to start doing subject twos, and I wanted you aware of it if you are interested in getting into real estate investing. So some of the cons of a subject to is the home could be seized. If the seller goes into bankruptcy, the home could be seized during that bankruptcy, okay? The lender could accelerate the loan and require a full payoff. You'll have to jump through some hoops from that. They could possibly do that, but then again, in most cases, it's not illegal, but in most cases, they want to have a good asset on the books, not a distressed asset that they have to liquidate and pay for and carry the cost of going through a foreclosure. And also, sometimes insurance could become more complicated. Not always. There are plenty of insurance companies who will insure on these, but there's also some that will not. So the bottom line, guys, of the subject to is, while it might seem desirable for some, there are risks for buyers and sellers. So before you enter into this type of agreement, you should understand the various options along with their benefits and their drawbacks, okay? So questions I get asked about this is, how do you find subject to real estate deals? Well, to find subject to sellers, you need to look for homeowners selling distressed properties such as foreclosures, short sales, and auctioned homes. This hasn't been very common over the last 10 years, but we may start seeing this more and more as we enter this recession and the real estate market begins to correct. You can find these, there's free tools out there that will let you know if they're distressed properties, or get help with the real estate agent. Your real estate agent can help you do this. You will be paying them a fee, whatever they charge, to be able to do this for you and go through the transaction, but it could be a lot less than putting down 20%, turning something into a rental, etc. It's very creative. So why would a seller, and this is the next question, why would a seller agree to a subject to mortgage? Why would anybody do that? Well, sellers who agree to a subject to mortgage, they're usually pretty desperate to sell a home quickly. They may be in danger of a foreclosure. They may have been unable to keep up with their mortgage payments. It may not be an ideal scenario, but it can make for a quick sale and keep the bank out of the equation, okay? So hopefully you know some more about subject to loans and creative financing. Of course, there is other ways to do creative financing, but this is going to be, I think, a major factor here coming up soon in our changing real estate market. I think investors are going to start helping people who are in distressed situations. Then again, if you list with an agent, you will be able to net more money in almost every single case. It just takes longer. The process takes longer. Okay, so you have to weigh those options. A lot of people need to be out now. They need their money now. They need it in a week or 2 weeks versus 45 to 60, 70 days selling it traditionally. So that's that. If you guys have any questions, leave them in the comments. If you have anything you need from me, let me know. Thank you guys so much for being here. Drop a comment, hit the like button, subscribe. I'm going to be out of town for the next week. I'll see you guys next week. Have a good one.